Let's take a look at how to allocate rental expenses on a vacation home. So there are some interest expense paid on this vacation home, and the owners, the Jeffersons, used that home for 30 days for personal use and rented it out for 200 days for a total of 230 days of use. The other time it sat vacant. They received $37,500 of rental income and incurred some $500 of rental advertising expenses. How do they allocate the expenses under the IRS and the tax court methods? So these are two different methods that we're going to look at. So first of all of the expenses are just given here, and they are categorized by Tier 1, Tier 2, or Tier 3. Tier 1 always includes interest in real estate taxes, and in this case advertising, because it's a direct expense of getting tenants on board to rent. The Tier 2 are utilities, repairs, insurance, and maintenance, and Tier 3 is depreciation. So to figure out how much of those expenses are deductible as rental expenses, the IRS method takes 200 days of rental divided by 230 of total use days and gets this amount, $12,121. The tax court method, if chosen, uses a calendar year, 365 as the denominator only for these Tier 1 expenses. All the rest, which means Tier 2 and 3, they use the same denominator of 230, the total use, as the IRS method. So you do get a different answer in the Tier 1 depending on which of these two methods are used. For a non-residence, which is considered rental property, the taxpayer includes all the income and deducts all of the expenses associated with that rental property. But if even one day is a personal use day, then there has to be an allocation of the expenses. The taxpayer cannot deduct the personal use portion of those Tier 1 interest expenses because it's not a residence, and you can only deduct interest on a residence. The personal use portion of Tier 1 for property taxes can be deductible as an itemized deduction if the taxpayer itemizes, because it doesn't matter if the property on which the property taxes are paid is a residence or not, it's still all qualified as a deductible tax up to the $10,000 limit per year. That is new with the Tax Cut and Jobs Act. So in this example of a rental home, the Jeffersons decide not to use the home for personal. They just perhaps want to have some rental income. So they receive $37,500 in gross rental income. However, they incur even more than that, $50,439 of expenses related to that property. So the question is, we see there's going to be a loss from the rental. How much of those expenses can they deduct? So first of all, we have to realize or remember that rental activities are by definition through the Internal Revenue Code considered to be passive, and passive losses are only supposed to be deductible to the extent of passive income. However, there is an exception. So the entire $50,439 is deductible, so there is a loss of $12,939 because there's more expenses than rental income. Losses on rental property, again, are passive activity losses, and they're generally limited to passive activity income. However, there's an exception for rental real estate. Up to $25,000 in losses can be deducted each year. And in order to have this exception apply, you have to be an active participant in that rental activity, meaning you have to make management decisions or you have to invest time in that activity. And those rules were talked about in a different chapter. The $25,000 amount is phased out if the taxpayer's AGI is in excess of $100,000. So for every dollar that the AGI is in excess of $100,000, 50 cents of the $25,000 annual rental loss allowance is lost. The example here is that there is a loss of $12,939 from a passive activity, which is rentals, and assume that the couple has AGI of $120,000 and they're active participants. Because they're active, they can deduct up to $25,000 of loss, so you would think all of this can be deductible. But before we do that, we have to look at their AGI, and this is $20,000 over the $100,000 threshold, and so the amount by which the 120 exceeds that threshold, which is $20,000, 50 cents of that, or 50%, $10,000, is going to be a reduction in the 25 that they ordinarily could take. So 25,000 minus the phase out of 10 still leaves 15,000 that they could deduct. And since their loss of 12,939 is less than the 15, that loss is not limited. They can deduct the full amount. If the loss was more than 15,000, they would be limited to the 15,000 because of their higher AGI. A home can also be used for home office, and to qualify for a home office deduction, the home or part of it has to be used exclusively, that means all the time, or it means only for, and regularly, that means on an ongoing basis, not just once in a while, as either the principal place of business for the taxpayer's trade or business, or as a place to meet with patients and clients in the normal course of a business. And so this deduction is allowed only for self-employed taxpayers, and it's deducted for AGI. In other words, on page 1 of Form 1040, it's actually part of Schedule C, profit from a business or profession. And there are two methods, actual expense and the simplified method. So with the actual expense method, you allocate the actual expenses between personal and business use of home, and the expenses are categorized as direct or indirect. So let's say somebody has an office and they have an expense related only to that office, then that's a direct expense. An indirect expense would be one that relates to the entire home, and then we have to figure out what portion of that entire home is the home office, and then we allocate based on that, for example, square footage. And so the deduction for a home office is limited to the gross income from that business. And then you use the same tier 1, 2, and 3 sequence as we do for vacation homes. When somebody deducts depreciation related to their home office and later sells their home, to the extent that they took depreciation, so you add up all the accumulated depreciation for all the years, that part does not qualify for the exception, that $500,000 exception or exclusion on the gain on sale. And that gain would be taxed at a maximum of 25%. And that's because it's considered unrecaptured 1250 gain. Remember, Section 1250 is real estate. So in other words, if somebody has an office in their home and they take that depreciation deduction, later on they sell their residence, we have to say that it's not 100% residence because they used it as their home office for part of the life of the home. And so only to the extent of depreciation taken do they have to report that gain as income. The simplified method is to deduct the square footage times $5 a foot, limited to 300 square feet. So the max would be $1,500 no matter how large or small the office is, or how much the expense is. And so that again is limited to the Schedule C net income, less any business expenses that are not related to the home. So just the expenses of running the business. If one uses a simplified method, they don't take depreciation expense. And if they have extra expenses beyond the Schedule C net income, they do not get carried over. And on a year-by-year basis, the taxpayer can decide if they want to keep track of the actual expenses and allocate those expenses to the home office, or if they want to simply use the simplified method. This concludes the coverage for Chapter 14.